Hi, my name is Rick Meadows. Welcome to your training class here at T3 Live. I wanted to give you a little background of me and why I'm trading and so forth. And the purpose of this, I'm telling you this so that I can help you. Hopefully you can relate to some of the things that I'm talking about. I grew up in a relatively conservative area, northern Wisconsin, and my parents taught me growing up that what I need to do is get a degree, find a great job, live below my means, put money aside, and I'm going to have a great retirement. And that's what I did. I was, I finally got my college degree. I was taking, after I got my furniture and all of these things, little things paid for in my apartment and everything, I started investing in the stock market. And I got a financial planner. I let them manage my money. Now, what happened through the last decade or so, going into the middle part of 2000s, I was taking a look at the returns that I was actually getting on my retirement money. And I became very concerned because what I did is that the returns I was getting in my long-term bucket didn't match what I needed to retire with. So let's take a look. I went to to bankrate.com, and there is a great retirement calculator here. So let's just plug some numbers in here. Right here we see current age. We'll just throw it in as 45. Let's say a 45-year-old's household income is we'll say $100,000 a year, just to make it easy. Okay? Rate of return on the stock market before retirement. Let's say that you're getting, and obviously we've seen that over the last decade, the rates of returns haven't been very good, have they? But let's say you're getting 4% right now. Percent of income to contribute in your retirement. A lot of people, I would think that 5% of your total income going into your retirement package is actually pretty high, but there are people going higher. So let's take a look at what 5%, if you're contributing 5% of your income towards your retirement. Years of retirement income. We have to assume, first of all, I'm going to assume that we're going to retire at 65. And you have to assume that you're going to live to 100 years old. If you don't assume that you're going to live to 100 years old, and you do, you're going to be broke. So we need to do that. Current retirement savings. Now, a retirement savings for somebody who is, say a 45-year-old or so forth, maybe they have $100,000 set in some retirement account. Rate of return during retirement. Your rate of returns during retirement are going to be quite a bit less than they are while you're still working, because your risk tolerance is going to be going down. We'll say you have 4%. Expected salary increase. We'll say expected salary increase every year from today until you retire. Let's say that's going to be 2% of your total. Every year you're going to have a 2% salary increase. Percent of income at retirement. One of the things that when you retire, you probably are going to need less money to actually live on than you do while you're working, simply because, the kids will be gone. Hopefully they're all married. You don't have to deal with any of that. You're probably not spending any money for college plans and so forth. So let's say that you're going to need 75% of your money to retire on. That's what you're looking for, right? Let's include Social Security in here. So if these are your numbers or anything close to your numbers, you're going to be broke in your early 70s. And I'll tell you what. To lead a responsible life where you are going to, obey the law, you're not going to be, speeding down the freeways and things like that. You'll work hard, you live below your means. To be broke in your 70s, that's not a good way to go down. So one of the things that you want to take a look at, first of all, let's change the rate of return before retirement. We're going to increase that up to 7%. Historically, what the S&P is, or the stock market has given you is about 7%. If we were able to get 7% a year every single year from right now, you're 45 years old, for the next 20 years, right? Let's calculate what that looks like. If that was going to be your returns, you're still going to be broke in your young 70s, okay? That's a problem. There are a couple of ways that you can deal with this. Number one, you can add a larger percent of your income towards your retirement, right? Or you can actually change the rate of return that you're going to be getting. And so what we're going to be doing in this part of the video is that I want to take a look at the history of the stock market, and let's determine what is the probability of your returns moving forward. So let's do that real quick. The stock market has gone in a sort of like a 20-year cycle, and it has been doing this for over 100 years. If we take a look at our chart here, this is the Dow Jones from 1920 to the present, and what you see that if you purchase the stock market, and actually in 1920, this chart goes back to 90 years, so it's like late 1921. In 1920, the stock market closed right about here. Now, if you bought the stock market in 1920 and you held it to 1940, you can see that that's essentially a flat market, okay? Didn't really move anywhere. We had a big hiccup here in the center, but essentially, in that 20-year cycle, the market was flat. From 1940 to 1960, the market went straight up. You can see that big move that we had here from 40 to 60. 1960 to 1980, the market was essentially flat. From 1980 to 2000, the market went straight up. And this is where we're at over the last decade. So where we're at right now is exactly where we should be, according to the history of the stock market. One of the things that occurred to me when I was, thinking about this over time is that let's take a look. Are there parallels, or is this particular flat market different? Is it the same? Let's take a look. Let's go back to the chart real quick, and if we take a look, since we are in the middle of a 20-year cycle, let's consider what was going on in the early 1930s. Number one, the market was coming back, and people were pretty upset about what was happening with the banks. Everybody was blaming the banks for the current condition. The banks did this to us. Unemployment was going up. Underemployment was everywhere, right? People didn't trust the government. In fact, people were even questioning capitalism at that time. Is capitalism the best way for all of the people, right? Now, when we take a look at the next flat period of the market in the early 1970s, once again, we had a mistrust of government. We remember that Nixon was president, right? There were a lot of people pretty upset about that. We were in a war we didn't like, Vietnam. We had there was sort of like a little bit of a stagnation with the economy. We had some issues with the oil companies. We were taking a look at the Middle East and some of the issues that we're having there. And when we take a look again in the middle of this cycle, that's pretty much of the same thing that's going on right now. Okay? Now, when we take a look at the middle of the sustained rallies from 1940 to 1960, first of all, when we take a look at the early and mid-50s, what was the mood of the country? The mood of the country is that life is great. Not only is my life great today, but things are going to be better for me 1 or 2 years down the road. And without a doubt, my kids and my grandkids are going to have a much better life than I did. Right? Let's take a look at the early 1990s. In the 1990s, think about the mood of the country. Once again, we had hope. We felt good. We felt good as a nation. We felt good where we were going. And if you compare where your mindset was in the early 1990s versus 1980, it was a completely different world. Once again, we had confidence. Now, what does that mean? That means that with confidence, we're going to be spending money. If we are spending money, the economy is going to be growing. Companies are going to be investing in themselves. They're going to be hiring people. People are willing to, are able to find a job, find a better job. In fact, they could quit their company and they will go out and find a better job. I mean, a lot of people will get their raises through quitting their job and finding one with a better title and so forth, right? Now, when I was going through this process and learning about the stock market and taking a look at my retirement, I was doing this research and I became very concerned, because if this stock market over this 20-year cycle from the year 2000 to 2020 remains flat, we'll go back to that retirement calculator, my rate of return is not going to be 7% over this 20-year period, which I'm sure that you're experiencing, right? It is not going to be 7%. If this goes down or this changes, you can see with a 7%, with this particular person is going to be broke in the 70s. Imagine if you're not even getting 7%. And this is where a lot of people are at right now. I read an article in the Wall Street Journal here a couple months back that 90% of the baby boomers do not have enough funding for retirement, and it's true. I've talked to a lot of people. I've worked with a lot of traders, and a lot of people who are trying to manage their own money, make those decisions on their own. And when you take a look at where they come in, they think that they're okay. I've got 150,000. I'm 50 years old. I've got 150. I'm 50 years old. I've got $250,000. I think I'm okay. And when you actually run the numbers, you find out what a predicament that you're actually in. See, the problem is that if you are 30 years old and you have, you're concerned about your retirement, then you have plenty of time to do something about it, right? If you're 30 years old and at 40 years old you're broke, you still have time to do something about it, right? If you're 70 years old and broke, you're toast. You better have been nice to your kids, because if you weren't, you're toast. What are you going to do? And so these are the things that you need to think about. When I first got my first mentor, I found out that trading is about three things. It's about three things and three things alone. Trading is about probability, the use of leverage, and how do you manage risk. So let's go back and take a look at the last chart again, and take a look and let's determine what is probability of the stock, what is the probability of the stock market, and what is it going to do over the next decade. Okay? Now, first of all, I want to show you the move that we had from 1980 to 2000, that big up move. Here's a huge up move. This is that last sustained rally that we had from 1980 to 2000. And again, going to the next slide, you can see that this is the stock market over the last decade. This right here is where the stock market opened in January of 2000. And this is actually where we're sitting at today at the time of this recording. And what we can see is that obviously that the stock market is down 20% since January of 2000, and that's an issue. One of the things that I did, and what I was taught to do, is that, Rick, you go out, you live below your means, you buy mutual funds. Mutual funds are the safest thing that you can possibly do. You buy the mutual funds, and you're going to be okay. Mutual funds are diverse, and everything is going to be great. Well, number one, I read an article in Time magazine written in 2009 that 67% of mutual funds underperform the S&P 500. And when we take a look at the S&P 500, you can see those are some pretty miserable numbers, right? Market is down 20%, and 67% of mutual funds underperform the S&P 500. Okay? Now, if, say, for example, you were investing, and in January of 2000, you put $100 into a mutual fund that exactly performs as well as the S&P 500. And again, according to Time magazine, 67% of mutual funds underperform the S&P. If you are lucky enough to get yourself involved in a mutual fund that exactly mirrored the S&P 500, and we have to factor in, you're going to be getting some dividend, you're going to have some costs associated with that mutual fund, and let's say it did exactly the same as the S&P. You put up, Christmas of 1999, you get $100, you put it into a mutual fund, and you take a look at it today, and you go, oh my gosh, well, I guess I'm almost back to even. There's about $80 in that mutual fund, right? Because the market is down 20%, your mutual fund did exactly what the S&P did. I've got $80 in the mutual fund. I'm almost back to even. But one of the things that we have to factor in when we're taking a look at our retirement and we're taking a look at our annual returns is we also have to factor in inflation. You have to understand that if you have $80 today and you purchase a basket of goods, for example, you're putting gasoline in your car, you're buying clothes for your kids, obviously tuition costs have gone up in colleges, we have medical expenses that have gone through the roof. Now, if you took that $80 that you have left out of that $100 that you started with, and say you purchased a basket of goods, the same type of basket of goods that you would have purchased in January of 2000. You bought some clothes, you put some gas in your car insurance, you have all of these things, little medical expenses and so forth. How much money did you need back in January of 2000 to buy that same basket of goods? Well, if you took $80 today and you bought a basket of goods, to purchase that same basket of goods back in January of 2000, you would only need $60. So when you take a look over time at your account and you say, gosh, $80, I'm almost back to even. In fact, you don't really have $80 anymore. You have $60 because you have to take a look at your purchasing power. You have to factor in inflation and some of the other things. So understand that moving forward, in order for your long-term bucket to just stay even and just be able to buy the same stuff, your account needs to go up a minimum of 3.5% a year. These are the things that you need to start thinking about. See, what happened with me was that I was taking a look at my long-term bucket. I was taking a look at my retirement money, and according to the numbers that I had, the amount of money that I was contributing to my retirement, my actual rate of returns, which was not 7%, by the way, and I was taking a look at all of these factors, without a doubt, I was going to be broke in my mid-70s. And if this is you, what you have to ask yourself is, what am I going to do about this? Let's take a look again. Let's take a look at some probability. Let's take a look at what we have going on in the market to see, is this thing different? Is the market just going to explode moving forward? Is the market going to remain flat, or is the market going to go down? Because in the next decade, those are your choices. It's either going to go straight up, it's going to go sideways, or it's going to go down. I talk to a lot of people, and a lot of people say, market's just going to get hammered, without even talking about some of the things that I want to bring up to you. Okay? So let's take a look at this. The macro picture, the unemployment numbers right now, the unemployment is at 9.1%. 9.1%. Now, at 9.1%, we are not near anything close to a full employment. One of the things that obviously the government's going through right now is that, jobs, 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 jobs. That's all we're hearing. Jobs, 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 jobs. 9.1%. Now, you know and I know that 9.1% is probably low, because in order to be considered unemployed, you need to be looking for a job. There have been some people who have been so discouraged that they quit looking for a job. They're not considered unemployed, even though if they could find a job, they'd take it. My bigger concern is the underemployment rate. Underemployment is this. Say, for example, you had a job as a mechanical engineer, and you were able to you're a director or you're a manager as a mechanical engineer. You have a nice salary. You're making $80,000, $90,000 a year. The manufacturing goes overseas, and so now you're trying to find a job as a mechanical engineer, as a supervisor, as a manager, some type of leveled job that will at least give you the same salary that you were making, say $90,000 a year. And you're looking, and you're looking, and you're looking. And during this time frame, you're collecting unemployment. You're getting your $400 a week check. Well, $400 a week doesn't even come close to the salary that you were making previous. If you have kids at home, you still got to feed your kids. You still have your car payments. Still have your family. See, you have to understand that I've had people come up and they ask me, they say, Rick, what do you do for a living? And I say, well, my job is to take care of myself and my family. See, and that's your job as well. Your job is to take care of yourself and your family. And if you were in a position where you had a nice salary and a good job, and you're unable to get back into that specialty that you have, you are going to find another job. And probably you're going to take a salary cut just so that you can take care of your house, yourself and your family. Right? That's what we do. Now, say, for example, if you go from a $90,000 job down to a $60,000 job. Still a good job. You're okay. At least you're paying your bills. You're not, you may not be going out to dinner as much as you used to, right? But you're still taking care of yourself and your family. However, now you're part of the underemployed, excuse me. Now, this underemployment factor is not factored in when we talk about jobs, right? The underemployed. I read an article again in the Wall Street Journal 3-4 months ago, that the underemployment rate in the United States is over 17%. 17% of people that are qualified for other types of positions are taking a lower type of a position just so that you can take care of yourself and your family. Now, many of you who are watching this have jobs, and you say, well, what does that have to do with me? I'm getting there. Let me talk about that in a second, okay? So the underemployment, when we factor in unemployment and the underemployment rate, my estimate is that the real unemployment rate has to be around 20%. It has to be, right? And this has a major impact when we take a look at the stock market and what the difference is in the stock market during a sustained rally or one of these periods of flat times. Let's go back to this the original chart where we're taking a look at 1920 to the present. 1930, consumer confidence is extremely low. 1970s, consumer confidence is very low. And today, once again, consumer confidence is very low. And it's based on some of these things. It's based on the fact that people are not working or people are underemployed, right? We have, and these are some of the factors that obviously affect the stock market. Why? Fractional reserve banking. I want to talk about printing money and how the economy actually works in terms of money supply. You see, most people think that the Fed is the one who actually prints money. Yet they print money. They have the mint and they actually have the machines like cranking out the dollars, right? However, money supply itself is based on credit. Let me give you an example. Say I wanted to open up the Bank of Rick Meadows, right? And I go through the process with the Fed and go through all the paperwork and all the things that I need to open up a bank. Now, one of the last steps that I'm going to do is that I'm going to actually make a deposit with the Fed. Say I make a deposit with the Fed for the Bank of Rick Meadows of $1,111.11. The Fed says, welcome, Rick Meadows. You now own a bank, and you can make a loan up to $10,000, 9 times my original deposit. So now I have a bank, and say, for example, you come in and you say, Rick, I want a car. I'm going to buy a used car. I need $10,000 to buy the used car. And I say, that's fantastic. I've got it available. Let me check your credit. And I go through your credit, and I take a look at the probability of you paying me that $10,000 back. And I say, fantastic credit risk. Here you go. Here's a check for $10,000. Enjoy your new car. Now, you take that $10,000 check, and you bring it down to the car dealer. You say, I'm taking the car. Here's my $10,000. Car dealer says, here's your keys. Enjoy the car. Now, the car dealer is going to take that $10,000 check, and they are going to deposit it into their bank. Now, that bank, because of fractional reserve banking, they have a $10,000 check that just went into their bank. Now, they can loan up to 90% of what cash they have in reserve. So now that bank has an additional $9,000 that they can actually make a loan out for. You come up to them, or say I come up to them, I say, I'm building my business. I need computers. I need $9,000 to expand my business. I go in, you take a look at my credit history and my credit score, and you say, you know something? This is a good risk. That bank cuts a check out to me for $9,000. Here you go. Go buy those computers. I go down to the computer store. I buy $9,000 worth of computer. The computer store takes that check and deposits it in their bank, right? Now that bank has a $9,000 on deposit. They can make a loan up to $8,100. So now you can see how money is actually printed. Banks print money. Credit cards print money. When a credit card company issues you a credit card and they say you have a $5,000 limit on that credit card, then they just essentially print money. Think about it. So then what happens is, out of that first deposit that I made, $1,111, I made a deposit for $10,000. Next person made a deposit for $9,000. Next one made a loan for $8,100. And you can see how money supply grows. Now, understand that every dollar that you have in your wallet, every dollar that you have in your purse, every dollar that you have in your piggy bank, every dollar that you have in your savings account down at your local bank resulted from somebody else going into debt. Now, if everybody pays off their debt, there's no money. That's how it works. People don't really understand that. Take a look at fractional reserve banking. It was an eye-opening experience for me, believe me. So now what we have to take a look at, when we go back to this chart and we take a look at from 1920 to the present and during these sustained rallies, what we have is that during the periods of the sustained rallies, people are willing to go into debt because they have confidence. The 1950s and once again in the 1990s. Debt is a critical piece for our economy. It's the way the economy works. It's the way the banking works. It's just the way it's set up. So in order for people to be going into debt, there has to be a certain level of consumer confidence. And we all know that consumer confidence right now is very low. Okay? It's getting better. It's a little bit better than, certainly better than we had in 2008, but it's not near the levels that we need to have in the sustained rallies. And that is a significant piece of information to determine whether or not this stock market is going to remain sideways, go down, or go straight up. We have to factor in some of these things. Okay? Now we understand who prints money. We understand a little bit, have a better understanding of the macro picture. Let's talk real quick about other lines of credit. Small businesses' lines of credit have been slashed. And we all know, we've seen the articles, read the articles, heard it on the news. Credit, 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 right? Take a look at your own credit picture. Say, for example, if you had a decent credit score, say 680, 700, nothing too fantastic, but decent. You have 10% to put down on a home. Are you going to get that mortgage? What about your own credit cards? Take a look at how many people have had their credit card lines of credit cut. Or, say for example, if you want to take your credit card, you have a $5,000 limit, $10,000 limit on your credit card, and you have a zero balance on it. You go down to the bank and you say, I'd like to get $5,000 in cash on my credit card. Are you going to get it? Probably not. They changed that rule in January. In fact, most credit card companies are only allowing you and me to get a maximum of $500 in cash on a credit line that has already been established. Lines of credit have been cut. When we take a look again at the, well, actually, let me do this. I want to go and take a look at deficit spending. Okay? When we take a look at gross public debt, this is a chart from usgovernmentspending.com. If you haven't been there, I highly recommend taking a look at that site. There's a lot of great stuff in there. This goes back to gross public debt from 1792 through 2016, or at least the projection of going through 2016. And what we're going to see coming out of the Revolutionary War, obviously when we go into wartime, government spending is a little bit high and it pulls back. This blip in here, this is a Civil War. After the Civil War, what happens? Government spending comes down. 1920, this is World War I. Government spending comes down. During this peak here, this unbelievable peak, this is what we had during World War II. Obviously, we need to spend beyond our means to protect ourselves as a country. And after the war is over, what happens? Government spending comes down, including through the Vietnam War. You can see that spending was actually being cut while we were in war in Vietnam. Now, what happens, and this is a very interesting and important piece to the macro fundamental picture that we have right now. 1980, President Reagan was elected as president. One of the things that he believed in is that he believed that we needed to spend a lot more money in defense and different other things to break those commies. We're going to break those commies. Okay? Fine. One could argue that, in fact, we were in a war with the Cold War. Others and many people would say that not really a war. It was just kind of like we're still kind of positioning and so forth. However, you want to say we're at a wartime. Fine. We break the Russians. Now, so then when we take a look here in the 1980s, government spending as a percent of GDP skyrocketed. Now, the The Russians were broke somewhere in here, and what you take a look here is that you see that the government spending as a percent of GDP continued to increase. Now, my belief system is that since 1980, in order to get reelected in this country, the way you did that was not by cutting programs. It was by adding programs, by having pork on fat and all this stuff that we're adding to the government spending. Government explodes, right? So now when we go back to this chart, we can see that in the late 90s, we started, if you remember, we had a little bit of surplus that we handed off in early 2000. But you can see a percent of spending relative to GDP is relatively high. This is still at the highest point other than World War II in the history of the United States. Now what happens? 2000 comes across. We start spending money like there is no end in sight. We can spend, 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 spend. Government deficit explodes, goes straight up. Now, why is this a problem? Let's think about it. There are countries around the world that buy our bonds, buy U.S. Treasuries and so forth. This is the safest country to invest in. Now, what happens with this increased government spending, one of the ways that we are sort of paying off our debt is through inflation. In other words, if the dollar is worth less in the future than it is now, we pay off our debt. Sounds kind of crazy, doesn't it? Well, you have to understand that governments that are buying this debt will start to get a negative return on their investment in the United States. That's the problem. You see, if they're not going to get a return on their investment in the United States by financing our debt, they're going to slow down their purchases of our debt. And that's a problem. Because as we spoke already, we talked about money supply and how money works. In other words, you need to go into debt, I need to go into debt, companies need to go into debt to have money supply increase. When money supply is increasing, the velocity of money picks up, and there's just more money to go around, and there's a higher probability of people paying off their debt without going into bankruptcy or other negative things. The economy blooms. What we've seen is that over the last 2 years, the American consumer has pulled back and paid off over $1 trillion of personal debt. Ask yourself the question. And I'll ask myself the question. Am I going into a lot more debt right now, or am I pulling back? Have I cleaned up my house? I've cleaned up my house, and I'm suspecting a lot of you have too. Or you'd like to. You're probably not going into more debt right now, affecting money supply. With government spending out of whack, that's one of the reasons it continues to stay out of whack. But if foreign governments stop or slow down their purchases of our debt, that too is going to have an effect on money supply. Understanding, when we go back to the history of the stock market, in periods of sustained rallies, people are going into debt. Foreign governments are certainly willing to invest their money in the United States, right? When we take a look again at the history of the stock market, and we have the 20-year cycle, let me go back to that. Taking a look at the last decade, remember where we started off with? The market goes 20 years flat, 20 years up, 20 years flat, 20 years up, and so forth. We're in the middle of a flat cycle. In fact, we're essentially in a bear market from January of 2000. However, what we have seen is that in the actual market, we've had a significant bear market here when the dot-com bubble broke. Nice rally. This break in 2008, and this is where we're at again right now. A relatively flat market, but over the last decade, you can see that we're clearly in a bear market. Now, in the middle of the sustained rallies, people are spending money. Governments are willing to invest in the United States. People are going into debt. You are willing to go into debt. I'm more willing to go into debt because I know that there's a higher probability that I'm going to be able to pay off my debt in a strong economy. Unemployment is at 9.1%. We factor in the underemployment rate. We're at around 20% or higher, right? We have a lot of macroeconomic issues that point to me and say that the likelihood or probability that this market is going to continue to rally and go straight up for the next 10, 15, 20 years, how about 60 years until I retire, is not likely. In fact, the probability of that is nearly zero. But let's just take a look at the next decade. Let's take a look at the decade moving forward, going through 2020. There are three possibilities with the market. It will go straight up. It will go sideways, or it's going to get hammered. Those are the three possibilities. Now, having a better picture and understanding about the macroeconomic environment, what is the probability? What do you believe that the probability is? Now, if the market goes up, let's say, for example, the market goes up 50%, but with inflation, the value of the dollar is decreased by more than 50%. Even though nominally the market is up, it's still down from a purchasing power standpoint. We have to factor these things in when we're taking a look at our long-term bucket and also our short-term bucket. Let's go back to the retirement calculator and take a look at some numbers. If you remember where we started, we took a 45-year-old who's making $100,000 a year, rate of return is 7%, and so forth. Now, say, for example, if the market continues to go sideways for the next decade, you're not going to be getting 7% return. It's just not going to be there. Now, let's say you're going to get a 4% return, right? Now, first of all, if your returns go down as a result of this flat market for the next decade, because again, remember, the 45-year-old is going to be 55 years old, and they'll only have 10 years where the market will still continue to go up. So let's average it out and say, for example, you're getting 4%. There's only one possible thing that you could do. Number one, and that is to increase the percent of income you're going to contribute to make sure that you're not broke in retirement. Being broke in retirement is a terrible way to go down. I love eating mac and cheese. Love mac and cheese. I love mac and cheese because for me it's still a decision. If I had to eat mac and cheese because that's the only thing I can do, that mac and cheese isn't going to taste nearly as well. So what are you going to do to make sure that your long-term bucket of money is protected? And when we go back to the retirement calculator, let's take a look. Right now, this person is contributing 5% of their income, which would be $5,000 a year, roughly $400 a month. Okay? How about if we make that $1,000 a month? We'll make that 11%. Oh, still broke, young 70s. Let's change it to, how about 20% or 20% a year? So that'd be this. Now this person is going to be broke in the young 80s if you're making $100,000 and $20,000 a year needs to go into this bucket and then to at least put off being broke until you're 80. Let's take a look at 30%. This person's now broke at 87. Now, is there any realism to putting 30% of your income? Because remember, you're still paying taxes on this. This is 30% of your gross income, right? So let's take a look and go back to the original 5%, which I think some people are doing. And again, if you want to play with these numbers, go to bankrate.com, go to the retirement calculators, it's right there. Now, let's change the rate of return before retirement. Let's change it 10%. That's aggressive. Rate of return during retirement, we're going to say that it's not going to be, it's going to be a little less aggressive than you'll have while you're working. Let's say that you're able to get 7% there. I don't know. Now when we take a look, this person, now we're not adding any more to a retirement. What we're doing is that we're changing the rate of return on the investments that we already have. We're not changing our lifestyle whatsoever. How about 12%, 12.5%? Aggressive? Is it possible? You bet. Now when we take a look at your return line and your life cycle, not only are you not broke in retirement, you're leaving a legacy. My job and your job is to take care of yourself and your family. And it is in your highest responsibility to leave some type of a legacy. You don't want your kids taking care of you. This is my biggest fear in life, is that I'm going to be broke in my 70s. And so what I did when I was going through this process of learning about trading and so forth, what I needed to do is I needed to find out, what can I do to affect my rates of returns? This is where you're going to have peace of mind when you go to sleep at night. And in tomorrow's video, what I'm going to show you is that other mistakes that many traders make and how we can sort of change some of those mistakes so that you will be able to sleep better at night, as I do today. I look forward to seeing you tomorrow. Have a good day.